How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group and RetireSharp.com. Today's topic, I want to discuss in full detail what is a fixed index annuity and do a very thorough review regarding the basic components of a fixed index annuity. And when I'm discussing this, I'm not going to talk about a hybrid annuity, which is a fixed index annuity with an income rider. I just want to go off of the generic shell of just a regular, fixed index annuity plan, and then why some individuals try to leverage this for safety purposes and consistent growth purposes, as opposed to going towards a bank CD or going towards a regular fixed annuity. So I want to cover a couple of different topics, some of the problems with fixed annuities, and then also explain the what a cap rate means, what a spread rate, what a participation rate means, and then ultimately how you could cherry pick the best companies for your specific situation. So when you think of a fixed index annuity, understand it's a type of account that's offered through an insurance company. Insurance companies are the only ones that can offer annuity type contracts, just like insurance companies can offer certificates of deposit. Um, that's obviously offered through banks. Banks cannot offer annuity contracts. So like if you're going into a bank and somebody's offering you a fixed index annuity, they have to, that broker, that agent has to sell it through some sort of insurance company. And there's a couple of different features with a fixed index annuity. A lot of times individuals think they hear the word annuity, so they automatically assume income. When somebody's looking to get set up on a fixed index annuity without any sort of income rider, they're mainly looking at it as a protection standpoint and then also a growth standpoint. And you could leverage a couple different sources of monies. So for starters, a fixed index annuity can be established through old retirement plans like old 401k, 403b accounts. And what happens is you're able to roll over those monies into traditional IRA annuity accounts. So the annuity would be housed within the IRA account, allowing you to utilize qualified retirement monies to go into that type of plan. The other side is if somebody has a cash account, they just sold a business, they just sold a house, a car, whatever that is, and now they have cash, well, you could go and establish a fixed index annuity through something known as a non-qualified fixed index annuity. So those are going to be the two main sources, or what you're going to be able to have those options available to you. So some individuals like to utilize it for their retirement savings money that is deemed qualified retirement accounts. Others just want to utilize it as essentially cash accounts that is taxed a different way through something known as non-qualified accounts. Now, the ultimate benefits of this type of product is that it allows your money to grow when a linked stock market index goes up, and then allows you to have safety gain 0% when that linked stock market index goes down. So in a perfect scenario, if you think of your money like the term of a bucket, and let's say, someone has $500,000 that's inside of this fixed index annuity bucket, well, it's like a bucket with a lid over it. So what happens is with any sort of account, like a typical, traditional retirement account, like an IRA, an individual can add dollars to that bucket, which will obviously grow that bucket. But then this bucket is also associated not only with the contributions, but it's also associated with the rate of return. So if somebody's going in there, they have their IRA account that's established with a regular mutual fund. Well, depending upon what the performance of that mutual fund does, determines whether or not this rate of return is going to be positive or it's going to be negative. So in some years when the market's doing well, obviously this individual, the dollars that are sitting in that bucket, the 500,000 as this example, if after that year the market's doing well, well then the individual's also getting credited with positive interest credits, further compounding this bucket. And there's a caveat to that, because when you have mutual funds, when you have stocks, bonds, ETFs, if the market goes down or if that specific linked account goes down, well, you're also going to feel those effects with that bucket. So like in 2008, when you have average portfolios lost anywhere between 30 to 60%, and individuals walked into the year with $1 million, they could have walked out of the year with $600,000, all because of that negative rate of return. So individuals that utilize fixed index annuities or more want to take out that worry. They're saying, I want to consistently have a gain into my account, kind of like a bucket with the lid over it. The contributions are already placed in there, and the way that this rate of return works is it's either going to give you a gain up to whatever that index is linked to, if it goes up, and it's going to give you a plus 0% if that index goes down. So typically with these types of plans, which sounds fantastic, obviously, but it's not, you have a lot of smoke and mirrors. You have a lot of BS that happens with these companies, and they try to sucker individuals to go into their contract over the next company and might beat you over the head with very low cap rates, very low participation rates, very low spread rates. And it's ultimately not going to be as desirable as, a person first assumed that it would be. So why are fixed index annuities so popular today? And it all depends upon, what happened in the past to lead to obviously these products today, and kind of, what's the caveat, what's the reasoning to go into a specifically designed FIA contract as opposed to other options. And what used to happen was individuals would start saving for their retirement through their employer-sponsored retirement plans, such as their 401k, their 403b, their TSP, their 457 plans, and they would go make those contributions into those types of retirement plans, and their rate of return was linked to different mutual fund performance or different stocks, bonds, ETFs, mutual funds that are linked to the stock market. So from 1980 through 2000, individuals received, or the stock market was booming. It had over 1,000% growth in the market. So that means that essentially individuals that were placing their dollars into their employer-sponsored retirement plans, or even if they were retired, were able to leverage the market, hold on to that nice increase, and add dollars into those accounts and get a nice rate of return to further increase that bucket, more and more and more. Well, in 2001, you started to have shift, and you started to have volatility from 2001 to 2011. So you had, obviously the tech bubble bursting. You had '08, which was a large market disaster. And then in more recent times, you've had stock market volatility that has really scared individuals, and they made them realize that, okay, they can't just rely on the stock market to always go up. They now have to plan effectively and preserve certain dollars, make sure that they're being mindful off of the dollars that are at risk with the market, that they can actually lose all that money, and then try to put the other portion into some sort of safety realm. So let's say if somebody was contributing their dollars from 1980 through 2000, they've contributed all their money, they've received good growth, and now they're saying, okay, I want to retire. Right when they start seeing those hiccups in the market occur, their alternative is to say, okay, well, let me take my bucket of money and put that 100% to a type of fixed account. So that's when they started leveraging insurance-based products and bank-based products with their higher interest rate type returns. What I mean by that is an individual was able to, let's say if they've accumulated $1 million into their 401k related account, and they're going and now they're hitting that retirement age, they were able to purchase a bank CD, a 5-year bank CD paying them 10%, a 5-year fixed annuity paying them 12%, 13%. So what they could do is splice up their dollars amongst different bank CDs, 2, 3, 4, 5-year bank CDs, or 2, 3, 4, 5-year fixed annuities, and live off of that interest each and every year. So let's say if they went into a regular 5-year account, they would receive interest credits or interest of $100,000 each and every year in this example. For those 5 years, they would have made $500,000 of profit, of interest profit, and then after those 5 years are done, they would be able to utilize their $1 million that's sitting over there and then just reinvest it in a new 5-year bank CD or a new 5-year fixed annuity. So you could also set that up off of something known as laddering strategies, and this is where interest rates were at all-time highs. So you had it towards the 80s, the 90s, the early 2000s. Well, unfortunately, everything has shifted. So now you don't have the market that's increasing like it was. And now when you're looking at bank CDs and you're looking at fixed annuity rates, for a 5-year bank CD, it's paying right around 2%. If you're lucky. For a 5-year fixed annuity, it might be paying anywhere from 2.5% to 3% if you're lucky. So everything has essentially shifted. This individual does not have that same sort of power of going into that fixed account and having that safety, that mindset. So now they're saying, okay, well, do I go 100% into the market and try to roll the dice and take my chances that way to have a nice rate of return, or do I significantly reduce my budget and I mathematically try to determine when I'm going to pass away, and hopefully that's going to last me, until the day that I pass, so that I do not outlive my retirement dollars. So you have a combination of interest rates that have hit all-time lows, stock market that's been volatile as all heck, and then you now have something known as longevity risk, which is showing individuals living longer and longer and longer due to technological advances. And what it does is it brings out this big question mark to say, okay, I want to have safety, I want to have upward market-like returns, but I don't want to have that downward market type risk. And this is why the fixed index annuity space has been more and more attractive, and why you're seeing a lot of companies get away from that variable annuity space, the variable that says that it could go up or it could go down. And this is meant for the individual that wants to try to beat out the pace of inflation, beat out the low fixed interest rate environment, and still be able to receive a double-digit gain in their account in a given year, linked to the market, linked to the upward movements of a stock market index. But when that market goes down, they do not want to lose out to fees and downward market losses, further impacting their accounts. So in a given scenario, let's say if you have an account that's just linked to a regular variable account in the market, and let's say that account, the market goes up one year, down the next, then it goes up the next year, down the next, up, down. This individual could have rode that roller coaster for all those years, and they would have been back to where they started from inception. So when you have a fixed index annuity in a perfect scenario, what it does is it's going to gain when that index goes up, gain 0% when that index goes down, gain when that index goes up, gain 0% when that index goes down, gain when that index goes up, gain 0% when it goes down, gain when it goes up, flatline when it goes down. So it allows you to have more of that safety, more of that consistency. So when you're comparing it against volatile markets, one of the other features is something known as an index reset. Let me clear off the screen because it's looking a little sloppy. So the way that these accounts work is they typically work by 1 year point to points. So let's say if you have a fixed index annuity and it's linked to an S&P 500, and let's say that now that S&P 500 has a 10% cap that's associated with it. Well, and you establish a contract, let's call it August 1st of 2017. It's linked to the S&P 500, the S&P 500 has a 10% cap. What it does is you're going to receive that credit on August 1st of 2018. So if the S&P 500, let's say, gained 20% that first year, well, your bucket, they're going to open up the lid and you're going to receive a gain of 10%. You're not going to receive that full credit gain. The next year, let's say that the S&P 500 goes down 20%, well, you just received a gain of 0%, so it stays exactly the same. So also, one of the other things regarding that feature I just mentioned is called the index reset. So the way that works is, let's say if you're in a typical index, let's say that index initial starting value is at 100, then it goes up to 110, then it drops down to 50, then it goes up to 70, then it goes up to 100, and then you want to pull out your money, you want to sell your shares, whatever that is. You went in at 100, you left at 100. You did all that little song and dance and said, you know what, it's not worth my time. The index value reset would give you the gain. So now you start off at a higher value in year 2. Because it dropped down to 50 in year 3, your account had a gain of 0%. Then it went up to 70 in year 3. You would receive that gain. Then it went up to 100 in year 4, and you would receive that gain again. So you would receive a gain in year 1. You would receive a 0 in year 2, you would receive a gain in year 3, and you would receive a gain in year 4. So it works differently than being entirely invested into the market and having to deal with that whole song and dance. It's linked to you receiving your credit when that stock market movement increases, and it's able to increase by the time your annual point to point comes through. you have some crediting strategies that work on the cap. That's going to be the most common type of crediting strategy, saying that it's going to be linked to a stock market index like an S&P 500, and there might be a cap of 5% or a cap of 10% or whatever that is each and every year. So that says if you start your value on August 1st, well then August 1st of that next year, that's when they're going to say, okay, did the S&P 500 have a gain? If it had a gain, you're going to receive the gain up to whatever that cap limit. That's going to be dumped into your account. The next year, if let's say the S&P 500 goes down, well then you're going to receive a gain of 0%. So it's allowing you to have that safety, have that consistency of saying I'm never going to lose my dollars, I'm never going to lose my money if the market goes down, but it still allows me to beat out that potential of regular, fixed accounts such as a bank CD, savings account, fixed annuity, different things like that that might only be paying 2% of a flat interest rate. This allows you to have that potential to have, a 10%, 12% gain in a given year. And yes, some years that fixed account will beat it out because that fixed account is obviously paying 2%, 2%, 2%, while some years, if the market goes down, is only going to get a 0%. But ultimately, one large gain, one large year could give you, the equivalent of 6, 7, 8 fixed years. So I hope that logic makes sense. That's how a cap rate works. You also have something known as participation rates, which they might say, okay, your account is completely uncapped and it's tied to the S&P 500, but you have a participation rate of 50%. So what that says is if the S&P 500 gained 20% the first year, your account's gaining 10. If the S&P 500 gained 10% the next year, your account's gaining 5. If it gained 30% the next year, you're gaining 15. If the S&P 500 crashes, goes down, 50%, you gain 0. So you're participating in whatever that interest-linked credit is. Participation. First one's cap, second one's participation. Then you also have another one that's a spread. It's very common. So usually with the spread, the way the spread works is you might have like an S&P 500 with, let's call it a 3% spread, where it says if the S&P 500 gains 20%, your account's going to gain 17. If the S&P 500 loses 20%, your account's going to gain 0. So the spread just comes off of whatever your gain is. It doesn't affect if that account, only gains 2%. It's not like you owe minus 1%. It's just coming off of whatever that value is. Or should I say whatever that value gain is. So, what's the comparison? Why is that attractive? Well, obviously it's attractive when the market's doing well or is consistently doing well. And your alternative is not so much the stock market, because the stock market is going to be, or managed money or indexing strategies and all those different things, that's going to give you uncapped gain potential, but then it's also going to give you uncapped loss potential. This now more coincides with a safety realm, more along the lines of bank CDs, treasury bonds, fixed annuities. That's where this fixed index annuity space is. So the benefits are they're going to give you upward market gains. There's going to be no downward market loss. Excuse my chicken scratch. Typically with the contracts that we try to recommend, there's going to be no fees associated with it. So rather than invest your dollars with variable accounts and having a mutual fund related fee, having an advisor related fee, whatever that case may be with downward market losses, this is allowing you to receive gains with upward market movements, not receiving a fee associated with that bucket. So there's no little holes poked on the bottom of your bucket. Now the caveat to that is when you're giving up that liquidity, because with variable accounts, your money's completely liquid, meaning that if you don't like, a downward market loss occurred or you don't like a specific fee, you could go and take your money and walk away. With these types of contracts, there's going to be certain restrictions because the insurance company is giving you that favorable contract. They're saying we're not going to charge you any fees. We're going to allow your money to gain when the market goes up, not lose when the market goes down. So therefore, you have to stay put in this contract for at least 7 years, or at least 10 years, or at least 5 years. So each carrier is going to have a different specification. The sweet spot is going to be anywhere between the 6 to 10 year mark. So that's saying that if you're trying to go into this fixed index annuity, you want to at least stay committed on the low end about 6 years, the high end about 10 years, nothing beyond that. And what this does is it also gives you flexibility to take withdrawals as well. So if you need to pull out monies, or like if you want to trigger it with any time that you're receiving a gain into your account and just use that interest that you gained as income, you could do that. They allow you to pull out up to 10% per year. Majority of carriers allow you to pull out up to 10% per year, up to whatever that longevity is, that restriction is. So let's say if you have a 7-year contract, they'll allow you to pull out up to 10% per year for up to those first 7 years. After the 7 years, your bucket is completely liquid. So you played by the terms of the contract, you stayed put, you didn't try to remove all your monies, throw it in one day, the first year, and then remove all your monies at the second year. That's going to mess with the company's actuarial data. It's going to mess with the company's profits, and therefore they're going to penalize you through something known as a surrender charge if you try to pull out all of your monies before that time frame has elapsed. The very last thing is, how do you know if it's a crappy company or not? And one of the things I mentioned is I say you have over 1,200 different options in a particular state off of fixed index annuities. Majority of these options, I would say 95% of them are, excuse my language, are shitty options. They're very low cap rates. They're bait and switches where the insurance company is going to give this person a premium bonus and hit them over the head with a very low cap where they could never get a good gain. It might have been better off just going into a fixed account, or just leaving your money in a bank CD. So you have to be very careful. This is one of the things that we try to help you guys out with as detailed as possible. Is we have something known as a Retire Sharp planning system that allows us to scale through all 1,200 different options. We're an independent agency, so we're not going to be biased towards one company over the next. It depends upon what your age is, what your time horizon is, what your specific goal is, and whether you should segment a portion of your dollars into an FIA contract, into a fixed index annuity. So if somebody has $1 million, maybe they might have $300,000 that's in variable accounts. They might have $200,000 that's in cash accounts. They might have another $300,000 that's now sitting in some sort of fixed account, whether that savings account or bank CD or fixed annuities, and then you could have a smaller portion that's sitting in this fixed index. Or you could kind of splice up and say, I want to designate my dollars towards gaining market growth, but also have a little safety net sitting there with prevention of downward market losses. So maybe the dollars that you were looking to put into the variable side, you could splice that up 50% into a variable position, 50% into an FIA position to give you that favorable rate of return and give you that that safety with growth potential. And when you set this up the right way, what you can expect as a rate of return, on the low end, about 3% rate of return per year. On the high end, about 7-8% rate of return per year, depending upon how specific that we get, or depending upon what sort of options that are available through those indexing strategies. Some have very basic 3 components. S&P 500 is the only index. Others have like a Barclay index and 9 other components in there. So it really just depends upon your situation, depends upon what you want to see. And there's definitely a need for FIA contracts, especially in this market environment. The ultimate goal is to not place all your dollars towards this avenue, but place the appropriate dollars towards that avenue, just like anything. You want to segment it. Each process has to have its specific lanes, like a perfect puzzle piece. And once again, to recap, things used to be really simple. Individuals were able to throw their money in the stock market, have their money gain in the stock market, and never have to worry. Unfortunately, in early 2000s, we realized that could now be a detriment, that you now have market volatility. You have to have a more planned approach. You can't just go and throw your dollars into a fixed annuity, into a fixed bank CD, because unfortunately interest rates have hit all-time lows. So this is the reason to get into one of these contracts, or at least segment a portion or get interested into these types of contracts, because it could give you your safety with growth and allow you to have that nice consistent rate of return. No fees, no advisor fees, no mutual fund related fees, no downward market losses that are hindering this, and it can work out successfully. But once again, be careful, because majority of these contracts are crappy contracts. So the good ones, the ones that could suit for your specific situation, could be very good for your individual situation. At any point in time, whenever you're interested, give us a call, 1-800-566-1002. We offer 24/7 customer service, so we'll take your call mornings, nights, weekends, holidays, whatever the case might be. We are A+ rated on the Better Business Bureau. I believe it's because of the way that we do our methodical process. We try to educate first and foremost. And worst case scenario is you're going to be educated and saying what you're doing is correct. You shouldn't change anything. best case scenario is we find good solutions for you. So at the end of the day, we love dealing with clients, we love dealing with education, and we really hope that you found value in this, and this has at least helped determine whether or not this might be appropriate for your position, or whether this might be the worst thing possible for your situation. So I want to thank you very much for watching this video. Please feel free to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. Thanks so much, guys.